Things are still looking pretty choppy out here in Asia, and take a look at when it comes to risk assets, and we continue to see that decline resuming when it comes to stocks here in Asia. So Japan seems to be dragging that down. We're down close to 2% in Tokyo. Kospi as well, and Taiwan just coming online. And there you go. TAIEX is down some 2% just a few seconds into the trade. So, not much has really changed. If you take a look at how things are in terms of sentiment, I think it's still quite fragile out there, despite some of those dovish comments that we got out of Japan from the deputy governor from the BOJ. That helped at least lift up stocks just modestly yesterday. But, it was maybe that correction or reversal that we saw in U.S. stocks overnight that really kind of dampened the mood there. U.S. futures are still punching lower here, about a third of 1%. The dollar is down. Yields are actually back down. There was that bond action in the 10-year that was actually pretty bad that sent actually Treasury markets selling off. But that's reversed a little bit here in the Asia session as well. And we're watching very closely oil markets, just given there is now more heightened concern around escalation in the Middle East. One trigger was that news that Egypt was avoiding Iranian airspace because of some military drills. So oil extending the biggest advance in a week. Iron ore catching a slight bid here this morning, but Brent's hovering around that $78, $75, $79 level. Flip the boards here. We talk about what really drove things lower in the U.S. session. It was really the stock story and the selling of the AI names once again. So you're watching some of these chip makers in Asia. TSMC, there you go. We're down some 2%. Really enjoying the likes of Samsung, SK Hynix, Tokyo Electron in South Korea as well as in Japan. The setup for China is like this here this morning. You take a look at how volatility in the Nikkei as well, picking up a little bit after it did slow down the last few days or so, but still looking pretty elevated out there. But futures in China are pointing negative this morning. That trade data certainly didn't bode well. It did send a little bit of that rally for CGBs, but we're reversing a little bit of that now. We're at 214, 215 levels for your 10-year yield and 716.27 levels here. We've been talking a lot about the carry trade of the yen, but really there's a lot of maybe other nuances around the yuan carry trade we have to look about too.
Yeah, and that seems to be a vulnerable spot, which we'll talk about the note coming out of City Quant in just a moment as far as that is concerned. But, to Yvonne's point, when you look at these markets, right, so onshore stocks are down for 5 straight days. You're not getting a lot of volumes coming through. In fact, the volumes yesterday on the CSI 300 were, I think, the lowest going back to January of this year. Now, in the offshore markets, HS Tech, and certainly when you look at technicals there, yes, we did see a bounce yesterday, but the direction of travel on these moving averages is one where you get the 50-day now. I would say just a couple of days away from taking out the 200-day to the downside. I guess the silver lining of falling yields and falling rates and expectations building that the Fed cuts is a falling HIBOR rate, which is now, I think, the lowest since about May or so. We have a trading debut today, and open sesame, as we can say it, of course, later today at about the open. Sectors to watch: EVs, education, some of the big drags overnight. We talked about earnings. So Tokyo Electron is reporting today. As far as Greater China is concerned, SMIC, Moutai, Swire Pacific on the back of Cathay yesterday, Wharf Holdings, and also China Mobile all on deck today. But as Yvonne is pointing out, sentiment does remain quite weak. So I guess earnings will be taking largely a backseat to the macro stories taking place.
Joining us now for a little bit more context and kind of see where we are right now is Rahul Chadha, CIO at Shikhara Investment Management. Rahul, it's great to have you. How are you looking after these few days? I mean, this seems like right now people are still unwilling to really buy on this dip and stay in the sidelines. How are you taking it all in?
Yeah, no, I think the key debate is whether we're going to go into the soft landing or not. If you look at the rates are still high. So I think the best case, what happens is that beginning September, Fed quickly cuts rates over the next 12 to 15 months to come to the neutral rate. We're still in the soft landing camp. Our point is, look, markets got spooked by the payroll last week. They got spooked by the ISM manufacturing data. But the economy is not that bad. I mean, we've seen the services data which came through this Monday, which was fairly robust data. And there are no kind of a large-scale excesses. The excesses of the kind we saw in 2008 or 2000. So even if we have a downturn, it's going to be a fairly shallow downturn. So we will look at any significant pullbacks as opportunities to add to the positions we like.
Oh, okay. Well, speaking of, did you buy yourself anything nice this week, Rahul?
No, I think right now we just, again, at sidelines. So I think there is a bit more to go here because if you see the first steps again, one was not really very sure on that. One wanted more kind of a data points to kind of confirm that. And if you kind of rewind a couple of weeks back, the market was not baking in any slowdown. Now, it doesn't happen that rate cuts take place without a slowdown. So somewhere, as these a bit of a slowdown is baked into the estimates, is baked into the valuations, I think the risk reward then becomes favorable. So anything around whatever 7 to 10% lower, the Asian markets particularly become very interesting.
How are you repositioning? I mean, obviously, this is historic volatility we haven't seen in some time, Rahul. How do you look at these stocks right now? I mean, yes, you're looking for opportunities, maybe a bit more correction before you actually re-enter or enter. But, do valuations matter once again, especially when it comes to some of these AI names, which really nobody really cared until, a few days ago?
No, I think that's what's happening here. You've got the reality check which is coming through, and look, the broader indices have corrected by 5 to 7%. These names, if you see some of the memory names, are down 30-40%. So another 20% lower. I think the name gets relatively kind of an attractive. They would bake in some reasonable expectations. Let's not forget that. Look, 3-4 months from now, you will see some of these AI features, Copilot introduced in the new laptops, PCs, smartphones, etc. And look, it's been a while. We've seen a replacement cycle over there. So those products are ready for a replacement. You had to give a reason to the consumer to buy that. So I think that plays through. So one just needs the comfort in the valuations. And I think another 15% lower, that should come through. And you'll see buyers coming to buy that. And at the same time, like the way you said, as you get more data points that we going in a soft landing, that should give more confidence to the investors.
Well, Rahul, can we draw a straight line, or at least something correlated between the coming slowdown and the turn in the chip cycle? In other words, does that affect, do we see a buildup of chip inventory, for example? Because that directly affects, of course, some of these AI plays that you have.
Yeah, if you see now, you go through the earnings calls of the big kind of spenders, there's still a shortage of chips. I mean, they're still clamoring for chips. What we've seen is some of the delays in the high-end chips, etc. If you look at the mid-end chips, I mean, look at the old cycles, tech cycles, there was always this overbuild. We've not really seen that kind of an overbuild. See, we've not seen a smartphone cycle. You've not seen a PC cycle. So the traditional tech is literally dead, and which is where the hope is that AI features would give a reason for consumer to upgrade. So again, it was really that it just went one way up. There was fair bit of an exuberance. What we've seen is a lot of the market volumes are quant funds and some of these big pods, and they're very directional in the way they play. I mean, they just work on earnings revisions and momentum. And it works both ways. It works on the way up, and on the way down also, it can exacerbate things.
Is that why you're sticking to some of the North Asian names, like Korea, Taiwan markets in particular? And I know Korea, you mentioned, is one of your largest active weights right now.
So absolutely, we continue to like Korea, and this is basically premised on a soft landing. You see, what's happened is you've seen governance improve in last couple of quarters in Korea, and clearly they're looking over the shoulder and seeing what Japan has done, and there is this realization that by kind of improving this whole value of program, they can see a meaningful improvement in the re-rating. So that's coming through. We've seen genuine kind of a business improvements by some of these auto companies. Sitting here in US, I see the most improved SUVs in last 10 years are from Hyundai and Kia. So you can see their business is doing well. I mean, you can see them kind of Hyundai doing well in emerging markets also. Look, what US and Europe has not done for the last decade is infra spends. And some of the Korean companies are the biggest beneficiaries of that. So those trends are here to stay. These names did exceptionally well in last 12-18 months, and I think some bit of profit taking was but justified.
Right, and Rahul, the sense I get from the tone in your voice is you don't seem too worried. And at the very start of the conversation, you mentioned that we'll likely see more downside ahead in equity markets. I want to ask you about volatility, though. I mean, do you think the worst as far as vol is behind us, even with decline still ahead on price?
I think next kind of a 1 or 2 weeks would be a lot more volatile. See, what was happening was, again, the common trade was the yen carry trade. I mean, if you look at the shorts, those were huge, and people had kind of an borrowed there and spend this or whatever. Use that money to buy the growth momentum name. So you've seen a part of the unwinding. If you still look at the gross longs, those are still high. I think as these names correct another 10-15%, you will see signs of capitulation. And I think that is where you will see walls also settle. You will see policymakers come and reassure. We've seen some statements come in last couple of days, but as you get more reassurances, I think that would calm the market, that there is a policymaker put in this market. But that put is at a lower level. That's not at these levels.
We continue to see more. You mentioned about the yen carry trades. I mean, how much more further do you think this could unwound? I mean, JP Morgan has an update. Maybe 75% of those carry trades are closed now. Do you agree that we've seen the worst of this unwind?
Absolutely. I think that's the broad sense we get. And these numbers vary anywhere between 60 to 75. It's always hard to get an exact number for that. But bulk of this is done. And again, now what would happen is, rather than be on the sell mode, now one would be on the buy mode. So like the way I said, another 10% later one would be dipping the toes and looking to add to the positions.
Rahul, always a pleasure. Rahul Chadha, their CIO at Shikhara Investment Management in New York for us. Evening. His time, of course, this morning in the Asia Pacific. Coming up here on the show, some of China's largest banks are rushing to issue debts in a bid here to lock in these cheap rates and plug this almost $225 billion gap before the end of this year. More details in that story and that rush coming through the next few minutes or so. The opening bell 18 minutes away here in Hong Kong, in Shanghai, and in Shenzhen. You're watching the China Show. All right, so we're looking at, still looking at declines across the region, although the silver lining is we are coming off lows. And as you can see, the Nikkei, just like almost like clockwork, we're now just down 0.9%. We were down as much as 2% in the opening minutes going into the open today.
Yeah, your fix is just crossing your terminal right now at 714.60, which is a bit weaker than was expected. And you take a look at, or weaker than before, but you take a look at what we saw yesterday, which basically the PBOC did have set that yuan to the lowest or the weakest fix since November. So certainly maybe we're starting to see a little bit of a pattern being formed here. Let's get to our Asia FX and rates reporter Tanya Chen on this. There's signs the central bank is pulling back its support of the renminbi.
Yes, so we obviously have seen that in the recent days. The spot and the fixing gap has started to converge, and this positioning shakeout has really kind of helped relieve the PBOC of this prolonged currency problem, right? But I noticed today, I mean, the currency fix, it is on the weaker side, and so a lot of analysts are saying that there's still a bit of a weakening bias from the PBOC, and I think that's quite interesting to know, given that a lot of these banks right now, they're kind of coming out and they're saying, what is the risk on the yuan side, on the carry trade? So Citi yesterday saying that you have to actually watch out for the yuan positioning in terms of the squeeze on the yuan shorts, and that's partially because we've already seen such bearish positioning in the yuan in recent months due to things like the Trump tariff trade, things like that.
So is the risk then is if we do get a further squeeze, is a lot more downside still? Is that what Citi's saying here?
Yeah, that's exactly what Citi's saying here. But actually, there's two sides of the coin, right? Goldman is actually saying two-way flows are coming back. If you look at also on Chinese corporate side, they've been hoarding these long dollar positions for a while. They've been afraid of conversions, and so they actually have been hoarding $300 to $600 billion onshore of dollars. And so if you actually see them start to really make these conversions, that could actually have a meaningful impact on the market.
All right, Tanya, thank you so much. Our FX and rates reporter there. Just the breaking news, of course, the midpoint set above 714 for the first time since late of 2023. Right, China's big banks are on a debt issuance spree here as they plug this $224 billion funding gap before the end of this year. Min Lo joins us right now with this rush to issue more debts. And what do we know at this point about why they're doing this?
Yeah, so a couple of things. One is the market conditions, because the banks are trying to take advantage of the very cheap interest rates right now. And the other thing is the regulatory requirement, because the G-SIBs, the globally systematically important banks, are required to increase their total loss absorbing capacity to 16% by the end of the year and 18% by 2028. And on top of that, they also need more capital buffer under the Basel Accord by the end of the year. So Fitch Ratings estimated that there is a funding shortfall of about 1.6 trillion yuan, and that's why these banks are trying to raise more funds, and they can do so by a number of ways. Actually, they can issue more stocks, they can have more retained earnings, but we know that the profit margins this year has been very low because of the low interest rates and the weak economy. So when it comes to debt issuance, though, that's bolstered by 1.1 trillion yuan in callable bonds in banks. So many of these banks are trying to refinance now because the new deals are printed at record low rates, and investors are snapping them up as well because they are offering solid returns, better performing than the sovereign bonds, and there are just no better, high yield alternatives right now.
Meanwhile, you're starting to see this, intense battle between the PBOC and anyone that is buying CGBs right now. What was the latest that we've heard so far?
Yeah, so the PBOC did not conduct any reverse repo agreements yesterday. That's the first time that they stopped offering the short-term cash to banks since 2020. And analysts are saying that this is a sign that the PBOC is concerned about the bond rally. They want to limit leveraged bond buying. And this comes just, 1 or 2 days after, Yvonne, we were just talking about PBOC, the branch in Jiangsu, warning its commercial banks, its rural commercial banks, to stop buying huge quantities of those sovereign bonds and to limit their bond exposure. And these are banks, the rural commercial banks are the ones that are aggressively buying these sovereign bonds, but they don't have the balance sheet to protect themselves like the bigger rivals. And so that's why this is a dilemma that the PBOC has. It's trying to cut interest rate on one hand to boost the economy, but it doesn't want to lower funding rate to create a bond bubble that would jeopardize financial stability in the event of a market reversal. So that's why it's trying to, cut interest rates on the one hand and then threatening to sell bonds on the other hand.
The Fed cutting might help them address that dilemma, because that perhaps opens a window, if the Fed does cut aggressively, opens a window for the PBOC to jump through.
Yes, so more economists are expecting 3 rate cuts this year. They're expecting 2 before the end of the year after the surprise cut in July. And if that happens, that would be easing on a scale that we haven't seen in several years. And we know the economy needs it, given, yesterday we saw the very soft export numbers, which suggest that global demand for Chinese exports is starting to soften as well. And some economists expecting the PBOC to move within the next few weeks, given that we have seen the yield, the 10-year government bond yield between U.S. and China now at its narrowest since February. And so likely to have more cuts. That's good for the Chinese economy. Hopefully that will encourage more households and businesses to spend.
Thank you, Min Lo, there, our China correspondent, with the latest on, of course, that bond rally and what we're seeing when it comes to this debt issuance as well. You take a look when your Hong Kong pre-market just opening up now, and we continue to see them joining in on this sell-off when it costs global equities here today. You take a look at the Hang Seng, we're just down about 2/3 of 1%. 80-50 futures, though, are still flat this morning. But the weakest fix, and one that's above a 714 handle for the first time since 2023. That's helping to at least bring dollar China higher here this morning. So weakness in the renminbi. We got plenty more ahead. This is Bloomberg. Some big corporate stories that we're following for you today. Novo Nordisk's U.S. shares closed lower after disappointing sales of its weight loss drug Wegovy. Second quarter sales of $1.7 billion fell well short of estimates, and revenue from the drug was hit by higher than expected price concessions in the competitive U.S. market. The size of the shortfall raises concern about growing price pressures from rival Eli Whitney. Lily.
Second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So I would really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
DBS says Tan Su-shan will succeed Piyush Gupta as CEO when he retires in March, becoming the first woman to lead Southeast Asia's biggest bank. Tan currently heads the lender's institutional banking group and has now been given the additional appointment of deputy CEO. She has been credited with expanding DBS's consumer and wealth businesses.
Okay, going into the open, right, okay, so interesting last 5 minutes or so. So we were coming off lows of the day across the board almost in the Asia Pacific. And then we got that weak fix coming out of the PBOC, which then pushed equity markets again lower. Not on your screens, it's a Nikkei. I'm looking at that. We were down only 1.9%. We're now down again 1.4%. European futures are down. That goes into, I guess, the pressure we are now seeing going into the open today, 0.6% on the Hang Seng Index. And as you can see, it's now green on dollar China. Some weakness coming through in the currency on the back of that slightly weaker fix. A couple of stocks to watch, of course, today, and we do have a trading debut.
Yeah, maybe not a good day for AI chip maker to debut, just given the sell-off that we saw with NVIDIA and the like. But there you go. We're down some 33% for Black Sesame. They did raise about 1 billion Hong Kong dollars in this IPO. But yes, not a good day here today. In terms of other moves that we're watching out for, some of the biggest moves that we saw yesterday, this is how they're doing here today. The likes of New Oriental, those shares actually popped on that buyback program yesterday. We're reversing that quickly now. Xpeng's down another day as well, and watching NetEase and CNOOC as doing that. But CNOOC really kind of following that oil price, just given some of those Middle East tensions that we're seeing as well. In terms of the earnings side of things, there's plenty to unpack here this morning, whether it's in Japan, whether it's in China as well. We're seeing earnings due out in SMIC, Swire, Wharf, China Mobile as well. Kweichou Moutai, that's the big one in the A-share market that we'll get a preview of with our Bloomberg Intelligence in just a few moments as well. But there you go, Swire Pacific down some 3% at the pre-market. You're watching the China Show. We got the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down the open of markets, and it's not a smooth sailing day, to say the least. And you take a look at how broad markets are doing, and you're not quite seeing that dip buying as we might have seen, just given just the massive volatility that we've seen the last few days or so. So what's really sparking this right now? Obviously, there were some wobbles in the bond market. That weak bond auction in the U.S. did add to some more fragility into these markets as well. But yes, Hong Kong, China doesn't look like they're going to be doing any better here today as well. But yeah, we've been talking about that renminbi fix. Really just goes to show there is a bit of, I guess, tolerance for a weaker currency now. Yeah, and that's what we are getting right now. The weakest fix going back to, I think, November of last year, one where you have a 7.14 handle against the U.S. dollar. The opening bell, and if we did not get actually a very weak fix, you'd probably be opening slightly higher than the current levels right now. In any case, of course, that is water under the bridge, as they say. 0.3% downside on the CSI 300. That should now take that to, 6 days of losses on the benchmark itself. Volumes, of course, we've been tracking that very closely. I think the lowest volumes yesterday on the CSI going back to January of this year. Moutai, of course, is reporting earnings. We'll get to that in a moment here. Flip the boards and have a look at the Hong Kong Open, and you also probably see a trading debut today. We're down about 33% on that. We'll show you that in a moment, too. The Hong Kong Open is 142. A death cross is imminent on the Hang Seng Tech Index, so that's the 50 moving below the 200-day moving average. The silver lining of lower rates is HIBOR rates are coming down as well. So three-month low was the quote yesterday. Watch it closely when we go into today. Okay, a couple of big movers from yesterday and big declines overnight in New Oriental and Xpeng, and we are probably seeing that in the opening minutes too. As far as NetEase is concerned, that's also a big mover overnight. And also CNOOC is a big mover because of what's been happening with oil prices. Shanghai crude is up 2% in the opening minutes onshore. And a glance at the overall risk appetite, and you are getting declines across U.S. futures. European futures are actually seeing some substantial downside for this time of the day. And, of course, NASDAQ futures are now flipped to the upside. And Taiwan, though, is still down about 2%. TSMC, bottom of your screens there, 2.6. Yep. So we're still dealing with quite a bit of the headwinds there, volatility, the like, but we're focusing on earnings as well, and whether that could actually change the picture in any way. In particular, one really big large cap stock, which is Kweichou Moutai. We're watching very closely what happens with those first half results due a little bit later on. The liquor maker is seen as a barometer for Chinese consumer sentiment, which has been weak of late. Let's bring in our BI senior analyst, Ada Lee, joining us for a preview of what to expect in the second quarter results. We've been talking about the weakness in the consumer spending, the wholesale prices drop and the like. Do you think that's really going to impact this set of earnings?
I think in terms of this set of earnings, we're going to see minimal impact from those market movement. What we are expecting, or we believe that it will be about mid to high teens growth in both sales and earnings, and that is on the back of last year's price hike that was taken in November, as well as steady volume growth. In terms of the wholesale prices decline, we believe it's unlikely to hit the second quarter earnings because it literally only happens, towards the end part of the second quarter. And also for the sales of Kweichou Moutai, they sell it at ex-factory prices. So the wholesale prices, which is the market-linked prices, is unlikely to impact the numbers for now.
Do we then, I'm just looking ahead, do we then see that in this current quarter's earnings?
Well, we believe that in terms of the slump in this wholesale prices, in the longer term, they could eventually impact Kweichou Moutai's earning. In the short to medium term, the impact might be less or even to a lesser degree. And the key reason for that is what we're seeing is how much is there in terms of consumer demand, right? If the consumer demand in China continue to be weak at this current level, or even worsen, then we might see distributors stop ordering or order less for Moutai, and that will then impact Moutai's earnings and sales. And worse so, if the vicious cycle continues, then the distributors might even offload their existing inventory at the discounted prices. Then it's even going to exacerbate the problem. But is it going to happen in the near term? We don't think at the moment.
Yeah, you've been talking about the slashing of wholesale prices. I mean, it's across the board in some of their flagship products for Moutai as well. Does that signal that it's going to be facing more challenges in kind of rebounding?
Yes, we do believe that the rebound, a significant rebound, will be challenging because of the current consumer demand environment in China. However, with that said, the company has come out to do some price stabilization interventions already from late June, and we're seeing some quite effective result from it. So since the June low, in terms of the Fei 10 Moutai prices, till yesterday, the wholesale prices has rebounded by 9% already. So it seems like it's quite effective at the moment.
Ada, thank you so much. Ada Lee there, our Bloomberg Intelligence senior analyst. Sticking with earnings here, China's biggest listed chipmaker, SMIC, is also out with results later today. And we'll get a preview here with Belle, who's here with us in our studio to take us through the expectations here.
Well, they're not actually that great for later today because the guidance is we're going to see around an 80% drop in net income. Revenue is rising, but SMIC is facing really quite significant challenges. So it's spent a lot of money in the past couple of years on expanding the business. So those CapEx costs are really starting to weigh now. There's high depreciation that's coming through. But then in addition to it, SMIC is facing so much competition in that low-end chip market. So legacy chips, this is where Beijing's really making a lot of moves to capture the global market here. But when you have legacy chips, they're not really that complex or not nearly as expensive to buy either. And so SMIC is facing a lot of different margin pressure from that. Earnings call, we really want to know, are they going to get any sort of indications or give any sort of indications on price improvements in the second half? But certainly when you take a look at options, we're expecting some pretty significant price swing, so around 5% mark in either direction.
Yeah, and Tokyo Electron, that's another big chip maker that's also due as well. Nearly half of its revenue comes from China. What are we expecting there?
Yeah, that's right. So Tokyo Electron takes about 45% of its revenue from China at the moment. It's a chip equipment maker. So you've got Chinese companies that are trying to produce chips that buy the equipment from Tokyo Electron. It's been a big company that's been caught up in export restrictions, and we saw a lot of stockpiling of its equipment from China at the end of last year. And the big question mark in this reporting period was, would it face further restrictions? Those haven't come through from the Biden administration. And so what we hear from our Bloomberg Intelligence team is that they should expect to continue to see that sort of revenue, even if they did get slightly tightened, still around the 40 to 45% mark. But that's the expectation you're seeing there for earnings today. And the numbers should be overall pretty solid. You could see an operating profit jump of around the 50% mark.
Annabelle, thank you. Annabelle Jewelers there with a preview of what to expect out of these earnings out of SMIC today. Tokyo Electron. We're watching out for a debut as well. This is the AI chip maker Black Sesame. We're pairing off some of the initial losses, but we're still talking about a sinking of about close to 28, 29% here right now on the first day of trade.
Not good. Not good. Well, broader chip stocks are also down. We talked about that with Bill. We're down 3% on the Bloomberg Semiconductor Index today. Right, let's get to some other corporate stories we're tracking at this point. Warner Brothers Discovery shares here tumbled in late trading after second quarter results missing expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. The firm has concluded that cable channels are no longer worth what they were back in 2022 when Discovery acquired, of course, Warner Media. Now, Disney is forecasting a mid-single-digit profit decline in the fourth quarter. The company reported mixed third-quarter results with weakness at its theme parks offsetting its first-ever profit in streaming. Now, Disney sees pressure on park attendance lingering for the next few quarters after previously predicting a rebound in the final months of the year.
The lower-income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher-income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Coming off our exclusive series, Inside the Adani Group continues. We're going to talk to Jeet Adani, who heads India's largest network of privately operated airports, about the company's plans in infrastructure and defense. This is Bloomberg. Welcome back to the China Show. Adani Enterprises is said to be considering raising $1.2 billion through a share sale. That is according to our sources, who say that the flagship firm may seek to raise funds through a so-called qualified institutional placement. Now, they say the share sale could take place as early as September, and the move would follow a separate recent fundraising deal at Adani's power transmission unit.
And more now in our exclusive series on the next generation of leaders being groomed to run India's $213 billion. That's the Adani Group, of course, if not that obvious yet. So Jeet Adani is the youngest son of the conglomerate's founder and heads their airports and defense business. Now, the 26-year-old was a relative newcomer when short seller Hindenburg and those allegations of fraud rocked the group last year. We asked him how that period impacted him and also the family.
Jeet Adani is the youngest son of Indian billionaire Gautam Adani. As part of the tycoon's succession plan, the 26-year-old engineer is overseeing the running of 7 airports across the country, including the one in India's financial capital, Mumbai. The Adani Group is also building a brand new airport for the city at a cost of $2 billion. Along with airports, Jeet is responsible for the defense business, while also looking after the group's digital initiatives. The youngest of the next generation of Adani leaders is being groomed to run big parts of an empire that's been rocked in recent years. In early 2023, just a few years after Jeet joined the family business, a report published by short seller Hindenburg Research accused the company of fraud and share price manipulation. It sparked a $150 billion meltdown in shares of group companies. The Adanis have denied the allegations, and their shares have recovered, but they're still dealing with the fallout. Bloomberg's Anto Antony spoke exclusively with Jeet Adani and asked him how the group's strategies have changed.
You had just joined the business when the Hindenburg report came out. How did it affect you personally, and what role did you play in that crisis situation?
I think it was personally speaking, a very stressful and tough time. emotions were high. But I think the most important thing that was on my mind definitely was, what can I do to support, obviously, the family? But more than that, how do I support the larger family, which is the employees? Because the biggest risk that you run in times like these is demotivation. People, sort of losing hope. And to make sure that everyone is motivated, everyone knows that what we are doing is for a greater purpose. It's for, we're making real impact, and we continue day on with the work, because these things, they happen, they come, they go. But we don't want to lose motivation.
Some of the investigations or probes or allegations are still an overhang on the group. How are you assuaging the investors' concerns in these times?
So I think, and this is based on some of the interactions that I've also had with investors over the past couple of months. I think there's a clear understanding with the investors that, with the Hindenburg report, everything that was said and allegated against us was sort of just rehashing old things again. And a lot of investors really appreciated the kind of communication that we've done over the last 18 months. At the end of the day, not a single investor's query will be left unanswered. We were proactively reaching out to investors after each and every report or article or anything that was coming out. And with all the performance from the financial side also, they were very clear that, look, this is a very good asset. All of the companies, they have strong infrastructure assets, and the leadership team has given us enough confidence by communicating with us enough. I think that's kind of helped actually investors to realize that, to look beyond this and actually look at the asset, look at the leadership team, what kind of cash we're generating, and what kind of growth we're doing.
Jeet Adani there, the youngest son of Indian billionaire Gautam Adani, and our special coverage of the Adani Group continues tomorrow. We talked to Gautam Adani's nephew, Pranav. Now, he not only oversees most of the group's consumer businesses, but also runs one of their most complicated projects, redeveloping Asia's largest slum. Our coverage culminates with a special report at 11:30 a.m. Hong Kong time, with an encore presentation at 7 p.m. That's going to be 4:30 for folks joining out of Mumbai.
Yep. Catch all of that, of course. Right, turning now to some big geopolitical stories we're tracking today. Many of the UK's biggest banks and consultancies are encouraging staff to go home early this week as far-right groups plan more anti-immigration protests. Police were set to deploy thousands of officers across Britain after rallies in the past week then turned violent. The unrest is being fueled by an online misinformation campaign following the stabbing murders of 3 young girls in northwest England. Now, Russia is declaring a state of emergency in its border Kursk region as it faces a Ukrainian assault. It's the largest such attack on Russian soil since President Putin ordered the 2022 invasion of Ukraine. Moscow says as many as 1,000 Ukrainian troops have crossed the border and that Russia has deployed its military and air strikes. Now, Thailand faces fresh political turmoil. That's after its top court ordered the largest opposition party to disband for violating election rules by promising to amend royal defamation laws. Now, the court also banned the Move Forward Party's leaders from political activities for the next decade. The same court is set to rule next week on a petition to oust the Prime Minister over an alleged ethical violation. Plenty more ahead here on The China Show.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there are some elements of strength in the economy.
That was Roubini Macro Associates Chairman and CEO Niro Roubini there speaking to us about the U.S. recession risks and really what we heard from people saying, no, maybe we're overestimating the impact of this that jobs report that we got.
Yeah.
That maybe we're not heading to a recession just yet. Former New York Fed President Bill Dudley as well saying that the Fed is contending with contrasting economic data and needs to consider a shift in both policy and messaging in the coming months. He told us more about the balancing
facing
that is facing policymakers.
A couple things. Number one, we've seen a rise in unemployment claims. We've seen a drop in the hires rate. We've seen a drop in the quits rate. It looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOM rule, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. On the other side of the mandate, the inflation news has been very, very good recently. So it seems to me that the Fed needs to hold both sides of the mandate with equal weight right now, and that implies that monetary policy should be neutral, not restrictive. And we're a long way from neutral. I mean, people don't know exactly what a neutral monetary policy is precisely, but nobody thinks that 5.25% to 5.5% federal funds rate is consistent with neutral. Probably somewhere in the 3 to 4% range is where the Fed should be.
Bill, you've had an enormous influence on how people are thinking on Wall Street about what's ahead. So I want to ask you, if you think an immediate rate cut is not on the table, that they won't move into meeting, what would you recommend they should do in the next few weeks?
I think what they should do is change the messaging a little bit and make it very clear that they're now focused more on the labor side of the mandate, get the market attuned to the notion that if we get weak data over the next 6 weeks, that 50 basis points is highly likely at the September meeting. You can put 50 basis points firmly on the table if the data flow continue in the same direction.
And that was former New York Fed President Bill Dudley speaking with his fellow Bloomberg Opinion columnist, of course, Mohammed Al-Arian. That takes us into the conversation on, so you have the SOM rule being triggered, of course, and then I think JP Morgan raised their probability of a U.S. recession by the end of this year to, I think it's at 35%, from about a 20-ish percent. Although it's worth pointing out that at the start of the year, these probabilities that the banks were attaching to a U.S. recession when we were looking at 6-7 rate cuts was substantially higher. But again, we've seen a pickup in these expectations. Yeah,
Goldman also picked up earlier this week as well, but they were still throwing some cold water in the whole prospect of a recession. It's still not their base case here right now. But for JP Morgan, they say really it's that sharper than expected weakening in the labor demand and early signs of labor shedding that led them to actually boost those odds of a recession, 45% odds of a recession by the second half, according to the bank. But yeah, you talk about the SOM rule, right, which basically was screaming recession in some ways. And it's interesting, the woman that coined or that started it all, the SOM rule, Claudia Sahm, wrote a really interesting piece for Bloomberg Opinion saying, look, it was actually meant to be broken, that she doesn't think that what she's seeing in that SOM rule right now is really the reality of what they're seeing on the ground because of just the unusual disruptions that they've seen in the data and the economic tools that they used in the past 4.5 years.
Yeah, because of the pandemic, right? Yeah. And the new factors that's introduced into the labor market, which is, I think, in some ways fitting because I think the SOM rule, I think Claudia put that in place in 2019, if I'm not mistaken, if memory serves me correct. So we don't really have a lot of data on the SOM rule in other words, not being tested still. I guess if you back test it, then it probably will show you like the chart we showed, but post-pandemic, let's see whether or not we do get that first recession. Because we didn't hit a recession, right, during the pandemic, right? There was technically one, and then they said, no, we don't call it a recession at that point.
Yep. So maybe that helps assure the markets a little bit here as well, but you're still talking about some pretty much a lot of choppiness across there. I mean, you missed the first 3 days.
Yeah.
Of the bloodshed, but it was manic. And yeah, we were like, where's David Ingles when you need him? But it looks like we're still asking a lot of questions today, too, still. Yeah. Nothing's quite clear yet.
No, I mean, chip stocks, for example, are, we'll show that in a moment here, are still seeing some pressure coming through.
Yeah.
Our guest this hour, Rahul Chadha, talked about how, we can debate, soft landing or recession. And while we swing back and forth on that, you look at used futures, we will see a lot more downside in stocks.
10 to 15%.
10 to 15%. So he's not buying into this dip just yet. He's sitting on the sidelines because he is waiting for a deeper decline. And if you've been looking for a decline in chip stocks, this is one of them on your screens.
He said wait a little bit more, right? Maybe another 8 to 10% for some of these names to really flesh out some of the weakness and really the long positions that we've seen here, and wait for that yen carry trade to really unwind further, right? You have JP Morgan saying we're about 75% there. So, maybe we have seen the worst of that unwind here right now. But certainly you take a look at what's been going on across these markets here, and you're still seeing volatility that's quite elevated across most benchmarks here today. And you're still seeing that sell-off in even Chinese tech. HS Tech is down some 1%. Hang Seng, we're still around 0.7% to the downside here today. And we're watching very closely that fixes and the impact it has on the currency. 717, a little bit on the weaker side. Nomura is joining us next, too. This is Bloomberg. Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session. And yes, we're seeing a day of declines here across Shanghai. We're down about 0.4%. Broadly speaking, though, we basically saw a bounce of about 2 days that now seems to be hitting the skids a little bit here today. So most of Asia is heading lower here this morning. Tech shares continue to be selling off as well, Dave.
Yeah, the chip stocks, the chip complex in particular, to your point, is really dragging down the markets where you are getting a lot of that big representation. Korea and Taiwan will show you that in a moment. Overall, we're down over 2% as a group in that. TSMC, Samsung, SK Hynix, Tokyo, Electron, Advantest. U.S. futures have now paired most of the early losses. In fact, the Nasdaq has completely reversed now to the upside. Although we are, as you can see, still seeing some weakness come through, though. In European futures, we're off by over 1% as far as some of these contracts are concerned. It takes us into the region and how we're doing. We're actually doing better than we were 30 minutes ago, and we're doing better than we were about an hour back. Now, we're about 0.6% to the downside. You are getting some bright spots, although, again, it's the heavily weighted stocks dragging down the benchmark, the headline on this. Like Taiwan is down 1.8%, Korea is down about 1%, Japan is still seeing 1% declines here across on the boards as well. One to watch today is perhaps a risk that we haven't fully priced is geopolitics and increasing tensions in the Middle East with Brent crude coming through at about, I think we had a 2-3% pop yesterday. We are seeing some upside here today as well as far as that is concerned. And also, but just to tell you about this ongoing briefing in Japan, and the finance minister, they're talking about how they're keeping, as they should be, really, keeping a close eye on market volatility. Nothing much to tell you about as far as that's concerned.
Yeah, let's bring in Mark Cranfield now, our Bloomberg MLI strategist, joining us. And yet, it really was what we saw in the U.S. session, that reversal in stocks. Mark, you had a poor bond auction for the 10-year as well. It's not really, doing much in terms of the psyche for the bulls here right now. How are you looking at things this morning?
I think this skittish, erratic behavior is going to continue probably for most of this month. It's going to be very difficult to get out of this kind of malaise. I mean, don't forget the enormous price swings that we've seen towards the end of July, and then even more importantly, what we've seen so far in August. That has huge effects on risk assets in the terms of how people manage their portfolios and what it means to the volatility implications for them managing their P&L. So a number of people would have been squeezed out of the market. They won't be able to trade for the rest of August simply because of the restrictions placed on them by their own risk managers. So you're taking away a chunk of people who, particularly in the short-term trading, they won't be there to modify the big swings that we're seeing in the market. Plus, so you've got this nervousness anyway that when stocks fell so hard, whether it was in Japan or in the US, is it really a dip to buy, or should we wait for more confirmation? And the Federal Reserve in the background is not giving away anything about the idea of a big rate cut or even doing one before their meeting comes along. So there's no help from the central bankers there. And then you've got all this conflicting news coming out from the Bank of Japan. They're not helping the situation at all, really, by backtracking on some of their comments from having hiked just a week ago, and then they seem to be modifying that as well. So central bank are not really helping the situation much. Traders are already very nervous. And as you mentioned, in the background, there's a bit more anxiety about what's going on in the Middle East as well. It's certainly, if you don't have to trade, it's giving you plenty of excuses to sit on the sidelines for a bit longer.
Yeah, Mark, how much of what we're seeing now is because it's summer, because it's August?
There's certainly there's an extent to that. I should think the fund managers that managed to get away are probably very happy, although some may have been getting panic calls earlier this week when Japanese stocks were going through the floor. But other than that, yes, you would expect you would expect liquidity to be a little bit worse than usual during this month. And the fact that Europe especially tends to take particularly long holidays. The European Central Bank won't meet again until September, so there'll be no guidance from them either. So yes, you would expect there will be, when there is going to be market moves, they may get a bit extreme simply because people are not around. But if you look at the volumes which have been traded in the futures markets, it doesn't suggest that even if people may be on holiday, whoever's here is making up for it because the volumes have been very good. Equally in the foreign exchange market, volumes have been very, very high, especially in the options market. And if you look at, say, for example, the Swiss franc, which seems to be re-establishing itself as the main haven currency, there's been tremendous support for the Swiss franc, and whether it's against the dollar or the euro-Swiss cross. So that's a clear sign that people are very nervous. It hasn't gone away, and they're probably going to stick with those at least for the near term. What we may get from Fed speakers is they may try to dampen the people, try and calm people down a bit and say, look, this is getting a bit out of hand. We've got everything under control. We are going to move towards a rate cut in September, but it's not going to be a very big one. It's just part of our plan. That may help a bit as well. But certainly, every headline that comes through, if it's something that looks a little bit shocking, people are going to overreact to it.
Yeah, well, yeah, like what would we do about without market drama, Mark? Mark, just one final thought on, you mentioned that weak auction overnight. I mean, do you think that, and that takes us into the question of the day that we're posing, do you think that marked the top on treasuries?
Probably for the long end, there's a pretty decent chance, because if you think of so what caused the disruption last night, part of it was that there was a 10-year auction. They tried to price it below 4%. Investors were not particularly interested. And you can see why. I mean, the Fed funds is still at 5.5. To price a 10-year 150 basis points below where Fed funds is a big stretch. By any market conditions, that's a very long way to go. And if you think also that the Federal Reserve will probably be thinking that the neutral rate, when they finally start cutting, may be around 4% as well. So to try and price a 10-year bond below the neutral rate and so far below Fed funds is pretty difficult. And that probably tells you that, at least for the long-end yields, they're pretty much close to where people think they should settle. The short end may be a different story. Once the Fed finally gets going, there's probably room for 2-year yields to come down further and the curve to get rid of this inversion, which we've had for so long. But certainly, people will be saying that the long end probably is done for now, and it will need something pretty dramatic to get long-term yields much lower than they are now.
All right, Mark, thank you. Mark Cranfield there, MLI strategist, joining us out of Singapore. Yeah, have we seen the lows of Treasury yields yet here? Certainly, when it comes to that whole debate, whether we're in the soft landing camp, whether in the recession camp, we're starting to see JP Morgan at least lift those odds of a recession a little bit higher here, right? We're just talking about that report from 25% to now 35% that the U.S. economy might tip into a recession by the end of this year. Now, obviously, this is joining the likes of Goldman that talked about the risk of a downturn is a little bit higher. But, you know, I don't know if it's a base case right now that people are thinking that hard landing is possible.
Yeah, I don't quite understand why we're scrambling to see that a slowdown is upon us. I mean, the Fed jacked interest rates up so much. A slowdown was going to come at some point.
Yeah.
And this reminds me of the repricing that we got at the start of the year when we went from 6 to 7 cuts to 3. And we were surprised at that point were things actually this good, and now are things going to be that bad? The SOM rule, of course, was triggered, during the jobs report, the 3-month average of the unemployment rate. But a slowdown is ahead. It's a hard landing, or is it a softer one, of course? Let's put that question right now to Nomura and what the policy implications are for the rest of the region as far as central banks are concerned. Sonal Varma joins us, India and Asia ex-Japan chief economist at Nomura. Sonal, good morning and thanks for joining us. I know your colleagues in the U.S. have priced, and maybe if you could remind us what the house call is as far as the Fed is concerned in Nomura.
Sure. Good morning. So, I mean, clearly the downside risks to the U.S. Have increased after the softer July employment report, but there are both positive and sort of negative signs at this stage. Base case for us still is U.S. Soft landing. And so we think the Fed is not going to overreact at this stage. We are not expecting any intermitting cut. We are, though, expecting 325 basis point rate cuts this year, so 75 basis point in total in September, November, and December. So wait and watch is basically the mantra, I think, both in terms of Fed as well as our own house view.
Okay, wait and see. Does it at least lower the Fed hurdle for the region here as well? I mean, I think there's still some central banks, I guess Korea is one of them, that is maybe starting to talk about rate cuts as well. Do you think this kind of opens the window a little bit more?
It definitely, lowers the Fed hurdle. Although it's important to differentiate between central banks in the region that do follow the Fed and those that don't. We think within the region, Indonesia and Philippines are the two where we are likely to see earlier than expected easing cycle. So we've brought forward our first cut for BSP to next week and for BI in September. So we think these two central banks will be the first to move. Korea, of course, is watching the Fed and FX, although more recently the concern actually has been on rising house prices and financial stability. So we think BOK is going to move in October and not in August. Similarly, for the rest of the region, Reserve Bank of India is concerned about higher food prices. So we think they're going to be on hold for now, but we expect an easing cycle from October. So it's sort of a mixed bag because I think the policy reaction function does differ across Asia and not everyone is just following the Fed.
And to your point, right, there are domestic factors that these central banks are looking at in their economies. So just your thoughts on the Philippines, because you mentioned, so you're bringing that forward. The latest inflation report showed a reacceleration. This GDP print, which came out a few minutes ago, also came in quite strong at 6.3%. And I'm wondering how low do you think the BSP can get in this cycle, given that the economy seems to be doing okay, actually?
Sure. So I think actually this GDP print is much weaker than what we had expected. Sequentially, momentum has dropped. It's just 0.5% on a quarter-on-quarter basis. That's actually a very soft 2% annualized reading. So it's much weaker than what we had expected. We had above 7% for this print, given purely base effects. You're right, the headline inflation was high in July, but that's the peak. If you look at the forward-looking trajectory, the full impact of the lower import duties on rice tariffs, import tariffs, does mean that we are going to see a dramatic drop in forward inflation trajectory in the Philippines. So we think the next print is going to be in a two-handle, and going forward, even for rest of 2024, inflation is going to settle within the BSP's target range. So we expect the BSP to cut next week, as I mentioned, and we have 2 more cuts this year and 3 cuts next year. So we think the terminal rate will be about 150 basis point lower at 5% by the end of 2025.
And Sonal, you mentioned your RBI call pushing it forward to October, which is a little bit earlier than what consensus is right now. Our economists are talking about this as well, saying that, if you take a look at what's contributed to inflation, for example, some of these weights are a little bit outdated when it comes to consumer baskets and weights there. So that's exaggerating inflation. GDP prints have looked strong, but they're talking about this is really more about net tax collections than actually strong economic growth. So do you think that's warranted? And should they actually be cutting earlier than expected?
We've had the call for an October cut for quite some time, and we feel comfortable with that view, in line of the global developments as well. I think the challenge of food inflation in India is actually pretty concentrated in a narrow basket of goods like vegetables. If you look at CPI ex vegetable, it's actually running at 3.5%. All measures of underlying inflation in India, core goods, core services, are below 4%. In fact, they've been annualized stabilizing at below 3% and below 4%, in fact, for the last 12 months now. So underlying inflation is in check. Food inflation is not broad-based. And growth, as you mentioned, the headlines look good, but beneath the surface, consumption hasn't been that strong and private capex is not yet in sight. So the other challenge that the RBI has been flagging, which is credit deposit ratios are quite wide. We think that the macroprudential tightening RBI has done is having an impact in terms of curbing unsecured retail lending and bank lending to NBFCs. So we don't see any of the challenges that currently seem to be on the minds of policymakers. And therefore, we think by the time we get to October, there'll be greater comfort on inflation at a time when the real rates in India are above 2%. So we have the RBI cutting rates cumulatively in the cycle by 75 basis point by middle of next year, starting with the 25 this October. One final thing on the RBI, they do not believe in giving any forward guidance. I think all pivots from the RBI in the past have been surprises, so we should prepare for a surprise even in the future.
Speaking of surprises, we've been waiting for one for the Bank of Thailand to maybe give in to the wishes of the government. The consensus seems to be that they could still wait this out a few more months, maybe into next year. Is there a case, though, for the Bank of Thailand to bring their cuts forward to this year?
I mean, there's definitely a case, and that case has been there actually for quite some time. Inflation continues to be below the BOT's target, and we think growth is going to disappoint. We're building in just about 2.2% this year. Compared to the BOT's forecast of 2.6%. I mean, part of this, yes, is because of certain transitory factors like the budget delay and, the drought. But we see underlying demand is quite soft, and which we think is partly because of very restrictive monetary policy. Plus, the political uncertainty remains a headwind on growth. So in terms of the outlook for the BOT, the conditions call for it. But BOT clearly has been emphasizing a bit more on financial stability risk. So base case for us is BOT stays on hold. But given the political developments, we do see downside risks to growth this year and next year. And therefore, we would not be surprised if there's a pivot to cut in the fourth quarter of this year. But the trigger for that will have to be driven by a negative growth surprise.
Sonal, Varma, thank you. India and Asia ex-Japan chief economist at Nomura. Of course, you can turn to your Bloomberg for more on India's decision later on today. You can go to TLive Go, get more commentary and analysis from our expert editors here at Bloomberg. This is Bloomberg.
Welcome back. You're watching The China Show. We're looking at property specifically in these markets, specifically the Shenzhen exposed ones. Some gains here, modest, in some cases quite decent across some other names as well. Well, the news today is Shenzhen announcing some plans here to acquire apartments from developers for use as affordable housing. So again, more efforts here to tackle some of the unsold inventory there and then make that, of course, repurpose some of the inventory towards, I guess, more better use for the greater good.
Yeah, and I think according to the state media is that they're thinking that this could be the model, right? That maybe other tier one cities like Beijing, Shanghai are expected to follow what Shenzhen does as well. This is coming on the backdrop as well as Chinese cities are offering price cuts and sweetened deals to attract home buyers. And the effort comes a month after the country's top leadership promised to give local governments more room to set property policies. For more, let's bring in our Bloomberg Intelligence analyst, Christy Hung, on what you think of the latest measures and really what we've seen so far. Has it worked?
Right. So in mid-May, we have unprecedented steps in easing for the housing market in China. Down payment ratios are now at record low and mortgage rates to as low as below 3%. But if you look at the sales numbers in July, they're still down 20% year on year from a low base. And that is quite disappointing given the amount of shift in policies that the government has rolled out. So I think that's telling you why local authorities, a lot of them are getting more desperate in introducing more demand-side measures. The Guangzhou measure in lending out hukou to whoever buys a property is one of the steps that it has taken, and a lot of strong Tier 1 cities have already done so. So I think that is telling you, we should be expecting more of such kinds of steps in the coming months if the home sales numbers aren't showing results.
What currently do you think are the hurdles, though, that seem to be slowing the recovery in the housing market? Because we've been here, so we talked about May being, the month where they really stepped on the gas here, but we've been looking at 3 years of the downturn, rounds and rounds of stimulus, for example, and I'm wondering whether we just haven't waited long enough to see the efforts come through.
Yeah, I think the biggest problem here is still confidence. We need households being confident about their job security. We need them being certain about the outlook on home prices, that home price is going to go up. We need them also being certain about that developers will be able to complete pre-sold homes. So I think regulators understand these concerns, and they have already started, introducing measures to tackle these problems, like addressing the demand-supply imbalance in China. We talked about unsold properties being purchased by the government. I think I understand why Shenzhen is trying to step up these measures, because if you look at PBOC's number, the 300 billion yuan quota that the central bank is introducing, as of end June, only 4% is utilized. So that slow implementation is telling you why, why this is hampering our sales recovery in China and why more needs to be done.
How bad are the earnings going to get for the first half then for some of these developers?
Yeah, so if sales are still down, that is going to limit developers' liquidity. That's going to limit the capacity to complete homes. So if you look at their homes being delivered in 1H, it's still down year-on-year 25%. So we expect that is going to drive a 30% decline in the revenue. And on top of that, that would be squeezed to the gross margin, because they have been introducing price cuts to purchase inventory. So that is going to be a double whammy to their earnings.
Christy, thank you so much. Christy Hung, our Bloomberg intelligence analyst there that covers, of course, the industry for us here. Right, as we go into the last, 8 minutes in the morning session in Japan, interestingly enough, the Nikkei has now erased its earlier loss of 2.5%. So speaking of vol, you're still ever present, aren't you? There we go. More in the market story just ahead. This is Bloomberg.
Yeah, we're just checking what's been going on in the Nikkei, right? All of a sudden, we're seeing a big reversal here in stocks. We're actually seeing it in the green. They were actually the ones that were dragging Asia the most, and now there you go. So you got to wonder what's really driving this. There might not be that sort of trigger, but really, as Mark Cranfield mentioned from our MLive team, you're going to get used to this volatility, right? There's going to be days that things are going to go up, and things are going to go dramatically lower here as well. So massive price swings that we're seeing across Tokyo here this morning, and that brings us to what's been really driving a lot of this weakness and choppiness is really what we've been seeing in the tech space, right? So chips, certainly we've been seeing what happened in NVIDIA overnight, that 5% drop. That's really weighing in a lot of these Asia chip makers as well. Tokyo Electron, though, basically has erased most of those losses already. But Samsung, Taiwan Semi, still looking a little bit heavy here this morning. MSIC also comes out with earnings a little bit later on in China as well. And we're focusing on these Korean construction stocks as well. So massive moves there. Interesting note from the likes of KB Securities. So the brokerage is talking about, look, there was an indifferent first half, and now they're talking about interest rate expectations, the end of earnings season for the industry as well. So now is a time, they say, to focus on the companies that will get out of the bottom first, not on the vague hope of the sector to improve. So you see the likes of HTC, Hyundai, that's leading the charge. We're up some 13%. We got plenty more ahead. This is Bloomberg. 11:29 a.m. in Tokyo. We're heading to that lunch break, and yeah, we're dealing with volatility is the name of the game here today. We're taking a look at how the Nikkei is basically swinging back to gains here in just the last couple of minutes as well. So we're up about just 1/5%. 146.67. Maybe some signs that that unwind of that yen carry trade is at least waning here a little bit here right now. And of course, we're watching very closely. But yes, pretty strong volumes heading to that lunch break as well. In terms of, it's a big earnings day for Japan in particular. We're watching some of these reactions to the likes of Asahi Group announcing a buyback of shares. Isuzu there, also first quarter operating income beat estimates. If we can flip the boards and show what's going on with those stocks as well. Shiseido, that's seeing a massive fall though. Take a look at that. We're down some 15-16%. That is the daily limit, I believe. But basically they're saying, you know, the earnings were pretty bad. Negative impression there according to some analysts, and also weaker demand from China as well. We also saw with the China business, core operating profit for Shiseido fell some 10% year on year. And finally, when it comes to Lasertec, that stock surging after we saw a beat in the fourth quarter on record orders on that front. So there's that, and then there's SoftBank, Dave.
Yeah, also, so the company, let's look at the stock and how it did in the morning session here. I mean, the company says it is gearing up for more aggressive investments as it pertains to let's shift it and have a look at where we are, down about 3% in the morning session here. So yeah, more intensive foray into artificial intelligence. Min-Jong Lee is with us right now, our tech reporter out of Tokyo. Yeah, Min-Jong, why don't we start with a surprise buyback from the company? What triggered the company to decide on that amount here?
Right. This was quite a bit of a surprise because the message from SoftBank, including Masa Son himself, had been that now is time for the company to focus on investments rather than share buybacks. But I think what we did not see was the huge market crash through to Monday, which was the key reason behind share buybacks. Activist investor Elliott had been asking for share buybacks, but CFO Goto yesterday told everyone that not a single investor can make SoftBank make these decisions. So it was more of a market condition changes in the volatilities that really resulted in the share buybacks. As for further buybacks, everything really depends on market moves, according to the CFO.
And a surprise earnings loss too, Min-Jong. I mean, what does that say about SoftBank's outlook for the new fiscal year?
Right, and the loss was a surprise, and a key reason behind those losses were valuation losses from public holdings held by the Vision Fund. And given the increased market volatility these days, it would be difficult to anticipate any huge rebound in earnings, so we might be in for a few more difficult quarters for the Vision Fund and SoftBank. But one bright spot is the chip unit ARM, which has reported solid earnings, although the guidance was a disappointment to some investors. So we'll have to see how ARM performs business-wise and in terms of share price going forward.
And any further hints on anything else? New investment plans, outlooks, teasers from that briefing yesterday?
Right. Right. CFO Goto actually teased a little bit about, artificial super intelligence that Masa had been kind of really promoting these days. So their focus area is on AI chips, robots, and data centers. So I think we can anticipate some investments. The group did make 1.2 billion direct investments, including companies like Graphcore during the first quarter. So I think we can hope to see some more investments going forward, but I think a lot of this also hinges on market moves and market conditions, so we'll see.
All right, Min-Jong, thank you. Min-Jong Lee there, our technology reporter on SoftBank. Let's talk about another set of earnings that are coming up. Tokyo Electron may report higher quarterly operating profit from rising revenue, benefiting from robust demand for, yeah, you got it, artificial intelligence. Let's get to our Bloomberg Intelligence technology analyst, Masahiro Wakasugi, joining us now in Tokyo as well with the preview. Masahiro, what are you expecting from these results? And really, amid this sort of uncertainty that we're seeing in the economy right now?
Yes, we think that Tokyo Electron will report solid revenue growth in this June quarter. And they are guiding that around 20% revenue increase year on year for the first half. And probably the first quarter results should be around up 20% year over year. And its competitor peer, Lam Research, also reported around 20% revenue growth for the June quarter. So probably we will see that kind of revenue growth. And overall demand should remain solid going forward. So that's what we are expecting. And also maybe the demand from China should be one of the strengths in the June quarter. And we saw some other equipment companies, including Screen Holdings, reported solid results and the revenue, solid revenue coming from China. So we will see that kind of, probably we expect that kind of results.
Yeah, I'm just looking at almost 45% of the revenue in the last earnings results showed that exposure to China. So I guess what kind of details should we really be paying attention to here, when, particularly on guidance too, looking ahead?
Yes, probably we hear that from some equipment companies that the revenue from China should remain solid going forward. At the same time, we are also hearing the demand from other regions are increasing going forward, probably. So in that sense, the revenue exposure to China may come down a little bit going forward. And the more importantly, last week, Advantest reported the solid earnings, and also the company raised their operating profit guidance by 53%. For this fiscal year 2025 ending March. So that's a strong demand that should be coming from the AI-related processors. And Advantest was saying that the demand changed quite recently. So we would like to check whether Tokyo Electron is seeing that kind of similar demand changes or maybe upside going forward.
Masa, thank you. Masahiro Wakasugi there, our Bloomberg Intelligence Asia Pacific technology analyst. We're just getting some lines here crossing, and we've been talking to some of our traders, at least our FX and rates team has been, and really talking about what's been going on in the CGB market. So we're starting to see some yields pick up just slightly here on the Chinese 10-year yield. But what we're hearing is that some traders or state banks have actually sold the 7-year government debt. So that's helped pulling up some of the yields on maybe the belly to the long end of the curve here this morning. And obviously, we've been talking about this battle against this bond bubble that seems to be ramping up once again.
Yeah, but who was that bank who called the 7-year?
I forgot.
It's probably good that we forgot.
Stick to the belly. They said that's the safer part.
Yeah.
Maybe not so much.
Well,
yeah.
you know who you are. You know who you are. 7-year yields up 4 basis points right now. Just ahead, our exclusive series inside the Adani group of companies continues. We talk to Jeet Adani, who heads India's largest network of privately operated airports, about a company's plans in terms of infrastructure and also defense. This is Bloomberg. Welcome back. You're watching the China Show. More now on our exclusive series on the next generation of leaders being groomed to run India's $213 billion Adani Group. So Jeet Adani is the youngest son of the founder and heads their airports and defense businesses. The 26-year-old was a relative newcomer when, of course, that big story, the short seller, rocked the group last year. We asked him actually how that period particularly impacted him and also the family.
Jeet Adani is the youngest son of Indian billionaire Gautam Adani. As part of the tycoon's succession plan, the 26-year-old engineer is overseeing the running of 7 airports across the country, including the one in India's financial capital, Mumbai. The Adani Group is also building a brand new airport for the city at a cost of $2 billion. Along with airports, Jeet is responsible for the defense business, while also looking after the group's digital initiatives. The youngest of the next generation of Adani leaders is being groomed to run big parts of an empire that's been rocked in recent years. In early 2023, just a few years after Jeet joined the family business, a report published by short seller Hindenburg Research accused the company of fraud and share price manipulation. It sparked a $150 billion meltdown in shares of group companies. The Adanis have denied the allegations, and their shares have recovered, but they're still dealing with the fallout. Bloomberg's Anto Antony spoke exclusively with Jeet Adani and asked him how the group's strategies have changed.
You had just joined the business when the Hindenburg report came out. How did it affect you personally, and what role did you play in that crisis situation?
I think it was definitely, personally speaking, a very stressful and tough time. Emotions were high. But I think the most important thing that was on my mind definitely was, what can I do to support, obviously, the family? But more than that, how do I support the larger family, which is the employees? Because the biggest risk that you run in times like these is demotivation. People, sort of losing hope. And to make sure that everyone is motivated, everyone knows that what we are doing is for a greater purpose. It's for, we're making real impact, and we continue day on with the work, because these things, they happen, they come, they go. But we don't want to lose motivation.
Some of the investigations or probes or allegations are still an overhang on the group. How are you assuaging the investors' concerns in these times?
So I think, and this is based on some of the interactions that I've also had with investors over the past couple of months. I think there's a clear understanding with the investors that, with the Hindenburg report, everything that was said and allegated against us was sort of just rehashing old things again. And a lot of investors really appreciated the kind of communication that we've done over the last 18 months. At the end of the day, not a single investor's query will be left unanswered. We were proactively reaching out to investors after each and every report or article or anything that was coming out. And with all the performance from the financial side also, they were very clear that, look, this is a very good asset. All of the companies, they have strong infrastructure assets, and the leadership team has given us enough confidence by communicating with us enough. I think that's kind of helped actually investors to realize that, to look beyond this and actually look at the asset, look at the leadership team, what kind of cash we're generating, and what kind of growth we're doing.
You're overseeing construction of a $2.1 billion airport in the outskirts of Mumbai. Now, as I understand, the phase 1 construction is on time. However, my question is it too little too late? Because the way at which the expansion, the aviation market in India is expanding, would you have to work on the remaining phases at a much faster pace than earlier envisaged?
No, absolutely. I think you're right. If you look historically, when the initial privatization of both Bombay and Delhi happened together in 2006, Bombay as an airport was actually larger than Delhi. And it was growing at the same pace as Delhi was growing, but it hit a roadblock because it has a capacity limitation, being a single runway airport. And Delhi kept growing. It's now about 75-80 million passengers per annum. The latent demand of Bombay as a city is not stopped growing. People still want to fly. The ability to consume, ability to spend on travel is still very, very high and is still growing at the same rate. It's just that they don't have the option, or they don't have the infrastructure to be able to take flights. So definitely, when it comes to your question on too little, too late, yes. The good thing is we're getting there. Based on the initial conversations and what our forecasts are for the first year itself, once we start operations, we'll be pretty much exhausting 60-70% of the capacity of the new airport. And given that it takes anywhere from 2.5 to 3 years from start of a new project to commissioning, we will immediately need to start phase 2 of another 30 million passengers as soon as we finish phase 1.
You're overseeing the group's defense business. Now, India is a country with the world's second largest standing army. What scope are you seeing in the sector, and how are you going about it?
We primarily are focusing on areas where we think we can make a significant impact. That's why we're not chasing large capital projects like submarines or fighter aircraft, which we were in the past, but we've sort of redone our strategy now. Our strategy is focused on 3 things. The first thing is around unmanned systems, so unmanned aerial vehicles, ground vehicles, water and submarine vehicles. Our first milestone we hit earlier this year when we delivered the first drone to the armed forces. This was a male category drone. We have the capability to actually manufacture and design all the way from male category to micro rotocopters, which, small copters, you can use it for agricultural purposes as well. The second area around our defense ecosystem is on small arms. Small arms is very important because we see that based on the current equipment that the Indian armed forces have, a lot of modernization needs to happen, and we're very lucky that we've been able to win contracts to supply to them with an indigenization number of over 80%, and our target is by the end of the contract we want to hit to 100% levels of indigenization, so the entire value capture will happen within India. And the third part of our portfolio around defense is on ammunition. We are the only private sector ammunition manufacturer in India. On the small caliber side, we manufacture, and it's up and running already. We'll manufacture over a couple of 100 million rounds a year, which will be able to serve about half of the current yearly needs of the Indian Armed Forces. And we're also expanding into medium and large calibers. That sort of ties up the entire portfolio. Definitely when you look at scale, once all of this is up and running at 100% capacity, this will be a very large scale business in itself. As we actually are building out this capacity, we're also looking at new opportunities around defense where, cybersecurity, looking at systems, mission systems, not just manufacturing as an OEM, one drone or one equipment, but actually tying the entire thing together into a battlefield mission system. That's sort of more future looking, and then you have what we're manufacturing today.
So at this young age, you are running some of the big businesses in the region. At the same time, the chairman, who is in his early 60s, an age at which many people contemplate retirement, is putting in 18-hour work days. Do you think he feels confident, or you as G2 feel confident that if he decides to take a break, the G2 will be able to handle the businesses?
Yeah, I think on a lighter side, I don't think he's going to be taking a break anytime soon. For us, when we sit together as G2, the most important thing around this is self-realization. I think we all realize, as a group of 4 of us, that put together our capabilities are not going to be able to match up to his, because he's is a once-in-a-generation kind of entrepreneur. But what we can do better is, with the access and resources that we have, how do we train ourselves in aspects that we can control better? And we've identified, on being successful, you need 3 things. You need the right people, you need to be able to handle the right people, and then you need to manage risk. If we're able to do these 3 things as a family successfully, definitely we'll be able to grow. I don't think all of us are there yet in terms of capability on these 3, but this is where we're working with the right mentors to train us.
That was Jeet Adani, the youngest son of Indian billionaire Gautam Adani there. And our special coverage of the Adani Group continues tomorrow when we talk to Gautam Adani's nephew, Pranav. Now, he not only oversees most of the group's consumer businesses, but also runs one of their most complicated projects, redeveloping Asia's largest slum. Our coverage culminates with a special report at 11:30 a.m. Hong Kong time, with an encore presentation at 7. That's going to be at 4:30 in the afternoon in Mumbai. All right, we're going to get to some live pictures now, I believe, in Armidale, New South Wales there. This is the hometown of Michelle Bullock, the RBA governor. She has been speaking in the last couple of minutes, and some pretty hawkish comments that really echo what we heard from the RBA earlier this week, basically that they will not hesitate to raise rates again if needed. So they're vigilant over the upsized risks to inflation. And yes, they did consider, of course, whether to actually hike rates in that last meeting as well. So reinforcing that rhetoric as well, the Aussie dollar continued to stay pretty elevated this morning. We got plenty more ahead. This is Bloomberg. Well, the Paris Olympic Games are set to wrap up this weekend, and there's been no shortage of controversy. And really, one hot topic involves the Chinese swimming team. So they were able to get up quite a few, medals in the face of all this controversy, but it really has to do with this doping scandal, right? And first it was Pan Zhengle, the one that won with the world record and the like. There was also the men's 100-meter medley rally that basically where 2 of the 4 members of the team were listed as part of that doping scandal that actually tested positive ahead of the Tokyo Olympics just a few years ago. So the swimmers, have really started to comment on this overall. I mean, the likes of Adam Peaty, the British swimmer, talked about, in sport, one of my favorite quotes is what he's been saying. Is that there's no point in winning if you don't win it fair. He's been pointing the finger at, obviously the regulators, the people that have been looking at this as well to kind of do their job as well. And Michael Phelps, of course, the former Olympian as well. If you test positive, you should never be allowed to come back and compete again, cut and dry. But these swimmers have been, they've been tested multiple times a day while they were there.
Well, so I get there is history there. And, we've been talking about this on the show that they've been tested more than any other athlete when it comes to swimming, right? But they haven't tested positive, and not to say that they will or that there's any indication that they might test positive, right? So we can have the conversation once it tests. Right now, it does seem that it feels like maybe sore losers, really, I guess in some cases. Okay, anyway, let's talk about the Olympics still. Karishma Vaswani, our Bloomberg Opinion columnist, says the Olympic Games have always been political for China. She joins us now to talk us through this. Aren't the Games a matter of national pride for countries, Karishma? Why do you think in China's case it's different?
Yeah, I think it's really important to point out, in the first place, that for countries all over the world competing in the Olympics, winning is about national pride for sure. It's a way to showcase and highlight the sporting prowess of the nation. And so much money, so much investment and training goes into these athletes across the world. But I think what's really interesting about China is the fact that it's a way for the Communist Party to prove its legitimacy. And it always has been that way. Like from the 1950s, for example, it has been part of the country's culture to say that, look, the communist system can create world-class athletes that can compete and win against the democratic allied world. And I find that, particularly relevant since 2008, for example, when Beijing had that sort of massive coming out party in terms of hosting the 2008 Olympics. Now, at that time, the Chinese economy was on the rise, and for a lot of Chinese people, hosting the Olympics was a matter of real pride, but also a way to say to the world that, look at us, this is a country that has come from 40 years ago, a real low poverty base, and now is able to host a massive and at the time very successful event. But at this point in time, I think it's a very different economy that we're seeing in China today.
Karishma, thank you so much. Karishma Vaswani there, our Bloomberg Opinion columnist. You can check out her column, of course, on the terminal and also on the website. Right, we'll leave you with a look at markets. Fairly mixed. Off lows of the day, so we're doing slightly better and slightly more stable. That's it from us here on The China Show. Bloomberg Markets Asia is just ahead.